My belief is that the increase in the gold price that we've seen so far, as an example, has more to do with central bank buying and the weaponization of the US dollar than anything else. I think retail buying falls on as a consequence of people feeling the real bite of inflation, and as a consequence of that, developing a fear for the ability that they might have with fiat savings instruments to keep up with the deterioration in purchasing price of their savings, which has traditionally been the condition precedent for an increase in the gold price and ultimately the increased prices of gold equities.
On this episode of What the Finance podcast, I have the pleasure of welcoming back Rick Rule. Rick is the former president and CEO of Sprott US Holdings, with decades of experience in the commodities business, and now is doing a great work and actually sharing his experience with people through both online interviews like this, as well as sort of in-person events. So I'm sure we'll get to that a little bit later. But yeah, Rick, thanks so much for coming on the podcast today.
Always a pleasure. Thank you for having me back.
No problem. I'm looking forward to the conversation. And I guess my first question, everyone knows you as a commodities guy. So what is your outlook currently on the commodity markets?
I would say probably more bullish than would be evidenced in the broad market. My belief is that the increase in the gold price that we've seen so far, as an example, has more to do with central bank buying and the weaponization of the US dollar than anything else. I think retail buying falls on as a consequence of people feeling the real bite of inflation, and as a consequence of that, developing a fear for the ability that they might have with fiat savings instruments to keep up with the deterioration in purchasing price of their savings, which has traditionally been the condition precedent for an increase in the gold price and ultimately the increased prices of gold equities. In terms of the broader commodities, Anthony, I think the real story is the ascent of humankind, if you will. There are over 8 billion of us on Earth, more every day. We've done a great job over the last 40 years, increasing the material well-being of the poorest of the poor, raising 1.5 billion people from dire poverty being merely poor. That isn't to suggest that there's a lot more to do. There is, and we're going to do it. As poor people get more money, the things that provide utility for them are things that are commodity intensive. When wealthy people or middle income people get more money, they generally buy services, which are not commodity intensive. But when poor people get more money, the stuff that increases their sense of well-being is often stuff that requires stuff. The great commodities boom that we saw as an example in the decade 2000 to 2010 really came about as a consequence of the urbanization of China, and that process is being repeated around the world. As a consequence of that, I am bullish about the whole industrial materials segment, with the sole caveat, no, that's not right, with two caveats. One caveat would be the increasing role of government and the increasing amount of government theft with regards to privately generated wealth, including in natural resources. And the other would be the threat of recession. I'm no economist, but I note that sort of once every decade and a half, something goes way wrong. And it's been a while since something went wrong. So I'm a little nervous about the specter of recession, which would delay rather than change my forecast of increased commodity consumption and reduced availability. Sorry for that long-winded answer, but you asked, so I answered.
No, it's what we like. That's why people listen to these conversations, I think, because it's not the tidbits, not the short tidbits, it's the long answers, which actually go into the nuance of it all. I guess if we look at sort of other economies that you mentioned that are emerging from not poverty, but maybe from less wealth and are sort of getting to the point where they are going to be massive drivers of growth into the future. If we look at China, it was a government directed economy. A lot of it was to do with infrastructure investment, and maybe that sort of is a reason that we saw this great commodity boom, as well as their real estate market, which is sort of seeing reversals at the moment. Maybe it's a bit too much building. So do you see similar effects in these other countries like India and Indonesia, or do you think it maybe be a little bit more muted compared to China? What are your thoughts there?
Well, I would argue a little bit with your first premise. I think the increase in Chinese wealth that enabled them to build out the infrastructure really can be linked back to Deng Xiaoping saying to be rich is glorious. and the undoing of the communalization of farmland in China and the allowance of private enterprise. The Chinese made the money that allowed them to develop the infrastructure by building an export oriented economy and selling stuff to us. The Chinese benefited from low cost labor and all those things before Deng Xiaoping said to be rich is glorious. It was the privately led economy that allowed the state to build up the resources to build the infrastructure. I think it's very important not to put the cart in front of the horse. And we're seeing this gradual uh, liberalization of economies around the world, sadly, with the exception of Western Europe and the United States, which have experienced and seem to be retrograde liberalizing economies. But I think from economies as small as Malawi to economies the size of India, what you're seeing is the gradual realization that allowing some form of private enterprise makes the commune, if you will, the community, substantially richer. By the way, the work isn't done in China yet either. The Chinese estimate that urbanization needs to reach another 150 million Chinese in the next 20 years.
Yeah, it's a good point. And I think if we look at cities like Beijing and Shanghai, they're still growing quite a lot. It was maybe wasn't correctly distributed. Potentially, it was those tier 2 and tier 3 cities which are
Right.
really struggling, where no one wants to wants to really live. So what are the main? Are you thinking that this is going to be all commodities? Is it mainly going to be energy and I guess copper and the things to do with building? What are the ones that are going to benefit?
I think all commodities will benefit, but I think that investors will benefit from the biggest markets the most, which is to say they require the least effort, and they have the biggest and the best companies in them. So I would start with the oil and gas business. There's a perception around the world that, fostered by the big thinkers, if you will, that peak oil demand occurs in 2030 or 2032. This is pure hokum. Peak oil demand probably occurs in 2065. If you think about peak oil demand occurring any quicker, how would the big thinkers manage to fuel all the private jets that they fly to Davos to tell you to drive less? The truth is that we have invested as a group well over $5 trillion now to increase the market shares of alternative energies in replace of hydrocarbons, and we've reduced the market share of hydrocarbons from a high of 82% all the way down to 81%. So I would start with oil and gas. Not that I think it's going to do better than other commodities, but simply because it's such a great business. At current oil prices, oil and gas companies are making a lot of money. Despite the fact that they're making a lot of money, in particular, the state sponsored sector isn't spending enough money on sustaining capital investments to maintain production, which sort of suggests that prices will stay higher for longer. As I say, not maybe the commodity that will enjoy the greatest price increase, but the one that offers the greatest stability and the greatest free cash flow and the least risk for investors. I'm certainly a copper bull as well, but I'm not alone in that thesis. We have underinvested for 30 years in the exploration for and development of copper mines. The consequence of that, with the electrification of the world, is that we face almost certain shortfalls, supply over demand. The timing of that really is a function of whether or not we enter a recession or not. You can reduce supplies if you reduce demand via a recession, and you still don't get a price increase. Absent a recession, I think the copper business looks extraordinarily good. For investors willing to do some more work, I think that there is a lot of money to be made around the themes of rare earth and specialty materials, but these are not broad markets and these are not big companies. This is a very risky area that requires an awful lot of focused work in return, potentially, for some quantum returns. But the truth is, I'm bullish on most of the industrial materials over time.
Yeah, and it makes sense with what you're saying. So if we go, it's not something that you actually mentioned there, but LNG. Um, if I, so I work at a international oil company. I sort of have some exposure to this, and there's a lot of talk about. Yes, so I'm biased, just so everyone knows, but there's a lot of talk about there's a sort of a supply glut coming online in sort of 2026, 2027 in LNG with sort of more supply in Qatar, North America, and we're not even talking about Russia, which is potentially going to expand even further. Do you see that maybe being a risk? I guess in the
In,
next coming years.
yeah, I don't think it's a risk for a couple of years. I think it's a risk for 3 or 4 years after that. Remember, Anthony, the cure for low prices is always low prices, and the cure for high prices is always high prices. The delta right now between a million BTU of natural gas in West Texas at sort of $1.80 to $2, and the price of that as LNG last landed in Rotterdam or Shanghai or Tokyo at $8.5 per million BTU is too great a delta to last, and it's going to be resolved. I don't think it's going to be resolved uh, absent some supply. But the truth is, as LNG becomes more available, not just in terms of price, but also in terms of reliability of supply, I think that you'll see the market for LNG really, really, really recover. Remember, again, Anthony, since you work for a major oil company, the BTU price disparity traditionally between both land-borne and liquefied natural gas and, of course, crude oil, its principal competitor. You'll see that there's a lot of room left in the natural gas market. Will there be softness as a consequence of trains? What is it? 4 and 5 coming on in Qatar and the Northwest Shelf, and the continued ability of the United States to find export markets for their gas, and perhaps Prime Minister Trudeau willing the entrant of Canadian liquefied natural gas on the market. Yes, absolutely. Is this a problem in the 10-year time frame, in the 20-year time frame? Absolutely not.
Yeah, that's a good point. And I think another thing that we talk about a lot is there's sort of latent demand. So as the price goes down, some of these sort of economies that couldn't afford it when things went up a lot, sort of in Russia and when they invaded, they're going to come back into play. So Pakistan, they have the infrastructure. There's also other countries throughout Asia who their own supplies running low. So that's probably where it comes from. And obviously India, will they jump in or will they sort of continue to rely on coal? That's another question. But it's an
Anthony,
interesting market.
something that's important for us in the West to recognize that we don't talk about much is that there's 1 billion people on Earth that have no access to primary electricity whatsoever. There's another 2 billion people on Earth that have access to only intermittent or unaffordable electricity. And the truth goes for motor fuels. There are still 1 billion people on Earth that, from a practical point of view, haven't brought into this century. I think we're going to bring them into this century over the next 20 or 25 years. The demand numbers that we're using are rear facing rather than forward facing. And I think if you do that, absent something like World War or an incredible insurgence in socialism in countries that would seem to be wisely moving away from socialism to a market oriented response in order to increase their people. If you look at that demographic, what you realize is that the future is much brighter in terms of consumable extractables than not.
If I know you've been sort of you haven't advocated for green technology, and it's something that you mentioned before. And I was looking at the ETFs recently of low carbon ETF solutions. So there's sort of solar, there's wind, I think there's hydrogen, and then there was nuclear. And nuclear currently, they're calling it a low carbon, which is good, and it's far surpassing the other markets currently. Do you see that sort of being a trend moving forward?
I do. And by the way, I've invested in all of them and I support all of them. I would note, however, that in particular, wind and solar are intermittent sources of power. They're not areas of baseload power. And until and unless we make spectacular investments in the grid, making it addressable and distributable, uh, increasing reliance on intermittent sources of energy is going to require an awful lot of construction of peaking plants to provide reliable power when the wind doesn't blow or the sun doesn't shine. The brightest, if you will, of the non-carbon so-called alternatives is, as you suggest, nuclear, which is in a real renaissance. A lot of the environmental opposition around the nuclear industry has receded as a consequence of the fact that it provides reasonably priced and very available baseload power that doesn't generate either carbon pollution or particulate pollution. An extremely attractive outcome. They're building nuclear power plants around the world, 61 under construction the last time I looked, with 110 others in permitting or financing stages. So what we're seeing is a real nuclear renaissance, and we could do a whole interview on the uranium business if you were wanted to. It's a fascinating topic, unlike really any other natural resource that I follow.
And where are those plants being built? Are they mainly in China? Or are they sort of globally?
The ones that matter the most are being built in China, and China is assisting in the construction and finance of many others. But the truth is, we're actually building another nuclear power plant in the United States after a fairly long hiatus. And plants are planned or in the permitting or financing phase literally all over the world. The French are interested, the Finns are interested, the Russians, of course, are building like mad. They're building in the UAE, they're building in India. There really is a nuclear renaissance going on.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views. We've hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. And maybe without going into an hour-long conversation about it, what impact does this have on uranium? Because I know it's not all about supply and demand and that specific business.
We should start by saying the easy money in the uranium trade's been made. Uranium 3 years ago was priced at $20 a pound. Now uranium is priced at $92 or $93 a pound, having touched a high of $110 a pound. It's likely that the incentive price for greenfields uranium mine building is something like $75 per pound. What's more important to note, Anthony, is that the structure of the uranium market is changing very rapidly, from most of the transactions taking place in the spot market with overnight pricing and no security of either pricing or supply, to a term market where the price of the material and the deliverability of the material is determined by mutually agreed upon contracts between the buyer and the seller. What's unique about this is that for a lot of the nuclear plant construction around the world, the lenders for these very capital intensive plants are insisting that the promoters of the plant have tied up effectively enough uranium fuel to amortize the loan associated with the plant, a loan frequently in the amount of $5 or $6 billion. What this has done is given the uranium mine operators the opportunity to, with some certainty, lock in the amount of material that they sell and the price that they sell it to for 5 years, 10 years, 15 years. A certainty with regards to revenue and margin that is unavailable, as far as I know, in any other commodity on the globe. These contracts, unfortunately, right now are fairly opaque. The spot market is easy to see. The term market isn't so easy to see. I think it's going to take us a couple years to understand how to suss out the stability that producers like Cameco will have on a going forward basis around term contracts. My suspicion is that the companies that make good disclosure around term contracts will have a lower cost of both debt and equity capital. So my suspicion too is that 5 years from now, there will be standards of reporting with regards to term contracts that don't exist today.
Yeah, no, that makes sense. And I guess as you said, as the market matures, then the regulations and the norms going to come into place. But do you see this being I guess the future? Do you think this is going to be where a lot of the energy in our future comes from, or does it really depend on the society and governments and how they embrace it?
I think almost inevitably that this is going to be very important in the future. All of us in the West make reference to carbon. The Chinese government has pointed out in their own materials that they believe 500,000 Chinese people a year die from respiratory illness due to particulate pollution. And one of the things that nuclear does as an example, by backing out coal, is greatly reducing the levels of particulate pollution in particularly frontier and emerging markets, urban areas, and there, particularly China. So my suspicion is almost no matter what the big thinkers want, the market is going to demand uranium. The big risk factor there, of course, would be human error, which is to say another Fukushima, uh, another 3 Mile Island, another Chernobyl, or heaven forbid, another Hiroshima and Nagasaki.
Yeah, and I guess if that were the case, then we'd see what we saw 10 years ago, where everyone goes off it, and then after
Right,
Chernobyl, the same. So
right.
definitely don't want any of that. So if we go to precious metals, it's something that you said that gold has seen a massive leg up recently. It's sort of at all-time highs, and you were linking it to, I guess, this risk of what's happening in to the US dollar and potentially depreciation of it. Is that sort of what you think is increase the value of it, or is this something else?
I think in a rear-looking way, the answer to that's no. The buyers have been the central banks, and the central banks' motivations have been primarily the weaponization of the U.S. dollar, the attempted export of U.S. policy and political norms to other countries outside the U.S. dollar. The U.S. dollar, the United States government, pardon me, has tried to use the U.S. dollar to increase its influence in a bunch of countries that don't particularly want to be influenced by the United States. The consequence of that is that the countries have, of necessity, begun to substitute U.S. treasuries and U.S. dollars as both stores of wealth and mediums of exchange. We have seen consistent outflows from retail physical ETFs, which suggests that in Western nations, at least, the citizenry have not been active buyers of gold. In fact, they've been active sellers of gold. The gold price has moved up because the central banks don't trust the United States. And after not trusting the United States, they don't trust each other. So that the mediums of exchange outside the US dollar aren't really renminbi or yen or rubles or dinars or anything like that. Increasingly, you will see them short term in gold or in dollars. My belief, however, is that the ongoing deterioration of the purchasing power of a bunch of fiat currencies, but the most important of which is the US dollar, the reserve currency, will cause more and more human beings, as opposed to governments, to also view gold as a store of value. Anthony, it's worth noting that in the largest savings and investment market in the world, the United States, which accounts for, at last count, 23% of savings and investments worldwide, that the market share of precious metals related investments relative to other forms of savings and investment assets is less than 0.5%, which is to say that 0.5% of all savings and investment assets in the United States are involved in precious metals or precious metals related assets. The mean market share of precious metals over the last 4 decades, according to JP Morgan Chase, was 2%. So if we merely had reversion to mean, which is what I think we're going to have, you would see demand for precious metals and precious metals related assets in the United States, the foremost savings and investment market in the world, quadruple. And I think that's precisely what's going to occur.
Okay, so if we go back to the central banks, well, what has been the evidence that we've seen of them actually coming in and buying, and who is that? Is that sort of the BRICS? Is that other governments globally?
Yeah, published reports look for governments that don't have particularly good relationships with the United States. So look at the Turks, look at the Iranians, look at the Indians, look at the Brazilians, look at the Russians, look at the Chinese. People who were concerned, first of all, about the weaponization of the SWIFT banking system by the United States government, and then, of course, by the confiscation of the US government of $300 billion worth of US Treasury securities held by Russia. It's pretty clear that the United States has visions of being a global hegemon. And if you aren't in the United States, particularly if you're in a foreign government, if you are in a foreign government where your issues are perhaps not in line with the feelings of the United States government, you feel threatened, rightly, by the actions of the US government. You feel the need to store your wealth and have a medium of exchange outside the US dollar. That's precisely what we see occurring.
Yeah, no, that makes sense. So if we look at that, do you think, so you said it's potential to go back to the mean. When was the last time it was at the mean of sort of 2% of assets in the US being
I, I don't.
in
I
gold?
don't know the answer to that. That's information that I believe is prior to J.P. Morgan Chase. It's interesting too, and this is anecdotal. J.P. Morgan Chase suggests that the market share of precious metals and precious metals related assets in 1981, when they were at their peak, exceeded 6%. Again, that's anecdotal. They don't have specific information that goes that far back.
And I guess, yeah, I think a lot of people they struggle to see that because maybe they've expected this to happen for the last 10 or 20 years, and the gold price has gone up, but yeah, it probably hasn't been sort of it hasn't gotten to that stage where maybe people expected it would have been in terms of the overall global assets.
You raise a really good point, Anthony. People have been saying to me, Rick, when is the gold price going to go up? I began adding to my personal bullion holdings in 1998. So I view the ascent of the gold price really as having started in 2000, which is to say, in 2000, the price of gold was about $250 an ounce. Now it's about $2,100 an ounce. So I would suggest that gold has done what, 8.6, 8.7% compounded a year for 24 years. When is gold going to go up? Well, the year 2000. People have expectations that were set in the decade of the 1970s when the gold price went from $35 an ounce to $850 an ounce. Rational expectations would suggest that the answer to that question is in hindsight. My personal belief is that the rate of increase in the gold price is going to accelerate because of the deterioration in the purchasing power of the US dollar, particularly relevant to the interest paid on fiat denominated savings products.
And you mentioned there that it could, even if it went back to the mean, it could reach $8,000 an ounce. Is that sort of what you thinking could happen?
I think a better quote of what I said is that I don't own gold because I think it might go from 2,100 to 2,500. I buy gold because I'm afraid it's going to go to $7,000 or $8,000. The set of circumstances that would give you a quantum increase in the price of gold are almost invariably unpleasant. I would prefer that it didn't happen. I'm a 71-year-old guy, very happy with his current lifestyle. I'd like to see no disruption. But I see a whole bunch of reasons why gold could go to 7 or 8,000. I'm not saying it will. What I believe is that it is a contingency that is certainly worth insuring against if you can do it, and I can do it.
Yep, no, that makes sense. As you said, there's always the potential for that to occur. So it's better to be safe than sorry. And in terms of, I guess a lot of people have been looking at miners as well, and they probably haven't had the appreciation that the actual asset has had. So why do you see that being the case?
Well, I think the miners have deserved the poor favor that they're held in by investors. If you take us back to the decade 2000 to 2010, where the gold price increased from what, $250 to $1,900, more than a sevenfold increase, the free cash flow per share of the major mining companies declined. It took real management skill to generate lower cash flow at $1,900 than you had enjoyed at $250. And I think the investment community, myself included, looked askance at that performance and said, are these things businesses or are they floating abstractions? And of course, the value proposition among the length and the breadth of the juniors was worse. What this rather dismal point of view disguises is that some individual issues among both the big companies and the small companies added enough legitimacy and sometimes even luster that the markets from time to time did well. It is my hope that, given the fact that the management teams that presided over the value destruction that occurred in the decade 2000 to 2010 have been thanked and excused, and that institutional investors in particular are keeping the rest of the management teams in the sector on a much tighter leash than they did before. It is my hope that we begin to see margins in the business. It's worth noting, however, for investors, that although the gold price has been going up, the costs of producing gold have been going up too. Input costs in the supply chain for gold have been increasing faster than the rate of inflation, led, of course, by theft, which is to say not theft by miners, but rather theft by governments, royalties, taxes, regulations, offsite expenses, but also followed closely by other inputs costs like labor, energy, steel, and cement. So the margin increases that we would hope to have seen in the move of gold from, say, $1,800 an ounce to $2,200 an ounce, while they have occurred, have been somewhat muted as a consequence of the increasing price of inputs and government take.
Yeah, that makes sense. But then you said that you see this trend could be changing from a management perspective. So the company's a bit better managed. I'm guessing they have lower leverage. There's the potential that they could, at least from a if you look at the companies, that they're better run. So that should be beneficial for the price.
I think that's
Assume.
right. I think you'll see less stupid M&A, and I think that you'll see less speculative mine builds in the future. You saw some mines getting built in the 2000 to 2010 timeframe that frankly didn't make any particular sense given the interest costs that existed then, the prospective margin that existed then, and the capital costs associated with building them. You also saw, on a fairly uniform basis, a real blowout in terms of construction costs. Mines that in the bankable feasibility study suggested capital costs of 500 million coming at 900 million or a billion, which is to say 100% cost overruns. My hope, but also my belief is that the businesses are and will continue to be better run now than they were in the decade 2000 to 2010 in particular.
Sounds like it's a low bar, so you'd you'd hope so. So I'm going to go to a bit of an unfair question now. I guess from your perspective, it sounds like you're quite bullish on lots of different commodities. So from your portfolio's perspective, how have you positioned yourself maybe to take advantage of
My heaviest positioning
these
has been in
movements?
oil and gas. I'm an old, fat, rich guy now, so I don't need to get a 10 bagger or a 15 bagger on an exploration penny dreadful, despite the fact that I enjoy it and I do it. The biggest additions to my portfolio have been in the oil and gas side and among bigger North American companies that are easy for me to understand. And I think that this will continue to pay me dividends, literally, probably for the rest of my time on Earth. I, for the last 6 or 7 years, spent more time on the bigger side of the market, irrespective of commodity. I didn't feel that the market capitalizations of the juniors had fallen low enough to account for their increased risk relative to the big companies. So I emphasized the big companies. There is so little love left among the juniors right now that my goal for 2024 is to add some more risk to my portfolio and come way, way, way down the market capitalization scale. Whether or not your listeners should do this is really a function of how much experience they have and how much work they're willing to commit to their portfolio.
Yeah, it's definitely not a free lunch. Lots of work has to has to go into it. But yeah, Rick, thanks so much for your time today. Really appreciate it. I guess my last question is, what is one message you'd like people to take away from our conversation?
Well, I like to say, with regards to resources, they're capital intensive, they're cyclical. If you are not a contrarian, if you don't become a contrarian, you're going to be a victim. Before you invest your money, if you haven't done this, invest in yourself, invest in your own education. And of course, I have some alternatives there. If you care what I have to say about natural resources, go to ruleinvestmentmedia.com, list your natural resource stocks, and for no obligation and no charge, I will rank them personally 1 to 10, 1 being best, 10 being worst. Ruleinvestmentmedia.com. In addition, as you know, Anthony, once a quarter, I do a deep dive on a subject in something called the Rule Boot Camp. We've done uranium, silver, royalty and streaming, development stage companies. We're doing exploration and prospect generation next on April 20th. Charges $99 for about 8 hours of deep dive material. You'll have access to the recordings for a long time afterwards. You'll need them because you can't absorb all the information we're going to give you in 8 hours. The charge is $99 US to attend. And if for any reason you don't feel that we earned the tuition that we charged you, email me. I'll give you your money back. The financial risk is mine. Finally, the Natural Resources Investment Symposium, July 7th through 11th, is, I believe, the best natural resource investment conference on the planet. You can attend live, or like 1,300 other people did last year, you can attend live stream. Once again, there's an absolute ironclad money back guarantee. If you don't believe that what I charged you to attend live or in the comfort of your own home via live stream, email me. I'll give you your money back. I also want to note, Anthony, and 30 years of money back guarantees, my course material has been so good that I've had to refund less than 1/10 of 1% of the tuitions charged. Nonetheless, absolute financial risk is mine. Money back guarantee.
Yeah, it sounds great. I'll definitely put those on the description below. So if anyone's interested, just you can access them there. And as you said, you have lots of free information as well online. So sort of free videos as well on your website. So I'm sure they can check you out there, see what you have to offer, and if they like it, then they can sign up to those as well. But yeah, Rick, thanks again for your time. Really appreciate it.
I appreciate the opportunity to have this discussion and to visit with your audience through you. Thank you very much.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. You know, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.